I think it's helpful for every founder to understand the business model of a venture capital fund if they're going to pursue venture capital money and go down the venture capital path. I see far too often scenarios where founders might not fully understand the venture capital business model, and that leads to some distrust about the actions of the venture capital fund. Maybe it leads to them presenting pitch materials that aren't consistent with the business model. So it's something that would be helpful in both of these regards, just to understand the model a little bit. So when a venture capital firm wants to start a new fund, the partners that are going to promote this fund go out and attempt to raise money for the fund. They'll approach individual investors, they'll approach other types of funds, they'll approach school endowments, pensions, and other sources of institutional money, and try to get commitments from them to invest in this fund. The document that they use to market the investment opportunity is called a private placement memorandum, or a PPM, and the PPM contains a whole lot of information about the fund, like who's going to manage it, what the criteria is going to be for the investments, what dollar size investments they'll make, what industries they're going after, what stage investments they're looking at, and a whole lot of other details that are essentially going to place restrictions on the activity of the fund. Now, these documents are circulated to the prospective investors commit to it, and then they sign subscription documents, which also include a signature page of the limited partnership agreement. The limited partnership is the actual vehicle to do the investment. So this is the business entity that's set up to house the investment money and to make the investments into the portfolio companies or the companies that the fund is investing in. So the PPM is going to be binding to a certain extent because securities laws and fraud laws and so forth apply to circulating these materials in order to secure investment money. And then certainly the limited partnership agreement is a contract between all the limited partners and the general partner entity, which is the venture capital firm. And so there's going to be some contractually binding treatment to the operations of the venture capital fund. On top of this, the general partner entity, the VC firm, has a fiduciary duty to them to maximize the value of the fund and return an investment to them. There's a whole lot of convention that goes into this stuff as well. As far as the timeline goes, it's oftentimes going to be a 10-year term, where from the inception of the firm until the winding up of the fund and dissolving of all of its assets is set to be 10 years. The manager of the fund might be able to extend it for 1-year periods, up to a certain amount. But at least the sort of intent at the outset is for everything to be wrapped up within a 10-year period. And that makes sense, right? Because those investors are not trying to wait for decades for the final resolution of their investment into this fund. They're saying, yeah, we want this to be some finite timeline. In practice, it might go beyond 10 years, but generally speaking, that's the goal at least. In addition to the overall term, there might be somewhere between 3 to 5 years of investment period where all of the committed capital is going to be invested within that timeline, and the remaining time is going to be spent managing those investments and hopefully turning some of them into liquid. And then when you think about the actual investments that the venture capital firm is going after, from a statistical standpoint only, right, these are incredibly likely to fail. I mean, that's just the nature of early stage venture scale companies. They're 1 out of 15 might succeed, the other 14 out of 15 are just the cost of doing business. So when that venture capital firm is looking to make an investment in a specific company, it's thinking, look, we need to get at least a 20x return on this investment. Although that might seem excessive, you're saying, well, if 14 out of 15 are going to fail, you need that 1 out of 15 to make at least enough money to cover all those losses and a little bit more so that the fund overall is making money. And that's the nature of early stage investments. So in a vacuum, it might seem like an investor expecting you to return a 20x profit to them is onerous, but given the business model and given the likelihood that you would fail, that's just the nature of this kind of investing. The VC fund might also be in the hundreds of millions of dollars, sometimes more. So they are also looking for the opportunity to be able to invest more money. If they come in at Series A and they invest $3 million into a $7 million round, they're not really thinking that they're going to make a huge return on their entire $600 million fund based off of this $3 million investment. What they're hoping for is that this is one of the companies that scales, looks to be one of the ones that's going to be a success, and they'll make money off of that $3 million investment, but they'll also have the opportunity to invest into later stage investments and make some returns on those as well. Maybe they don't want a 20x return on the $100 million investment they make down the line, but they are hoping for that opportunity and for the ability to make a more modest return off of that investment later. And then you have to think too about whatever sort of restrictions that this fund has. One example might be that it's an impact investment fund, and that, aside from just the potential monetary return, that, there actually be some social good to this enterprise. That's a pretty niche focus, but just using it as an example to describe something that could be in a PPM that might be restrictive off of making any particular portfolio investment. So I think the couple of takeaways are that, one, your business, if you want to go down the VC path, your business has to fit within this business model. You're going to have to credibly convey to the investors that this is the type of investment opportunity that could produce 20x return on their investment, and might even have some opportunity for subsequent investments in later rounds. So the other takeaway is that if you do take investment money from venture capital firms, then you'd want to understand that the actions of the venture capital firm and the desires of the venture capital firm moving forward are going to be based off of this model also. They're going to want for you to continue to eye an exit within a timeline that fits within their term, and that the other actions that you take are going to allow them to continue to exercise the fiduciary duty that they owe to their limited partners.